Welcome to the Deep Dive. We're your space for really getting into the latest earnings calls.
That's right.
And today, we're looking at the Kraft Heinz Company, ticker KHC. Now, for years, KHC felt like it was, kind of stuck in this retrenchment phase.
Definitely. A challenging period.
But their Q2 2025 business update, which dropped pre-market July 31st, it kind of hints at something new, maybe a measured reinvestment, resilience even.
It does feel like a potential shift. So our mission, as always, is to cut through the noise for you.
Exactly. We'll distill what matters, give you the critical insights, the context, swiftly and thoroughly.
Okay, let's get into it.
So let's unpack this evolving Kraft Heinz story.
Well, first off, it was a remarkably solid second quarter for them.
Solid feels like the right word.
Yeah, they didn't just meet expectations, they actually beat consensus across the key headline figures.
Which, in this environment, for consumer packaged goods, that's saying something.
Absolutely. It points to, steady, disciplined execution, which hasn't always been the narrative.
Right. That discipline, it really shows in the numbers. Let's look at GAAP EPS. Came in at 7.55 cents. That topped consensus by a penny.
Okay, a slight beat there.
But the non-GAAP EPS, often what investors focus on more, that was stronger, $4.70, exceeded expectations by 0 and 2 cents.
Better. And revenue?
Revenue hit $6.62 billion.
Yeah.
That was a $30 million beat. And maybe the most notable thing here, it held flat year over year.
Flat. Which, in this climate, with volumes under pressure everywhere.
Exactly. Flat is actually pretty good. Almost an achievement.
It really is. And beyond the top line, they showed some impressive margin control. That's been a strength.
Yeah? How did that look?
Adjusted EBITDA actually increased 1.6% year over year, came in at $1.5 billion.
Okay.
And the gross margin expanded by a significant 120 basis points compared to last year, reached 34.5%.
Wow, 120 basis points. That signals real strength in managing costs and pricing, doesn't it?
It absolutely does. Operational prowess, as you said.
And speaking of strength, their free cash flow, that really stood out. $926 million. That's a solid 9.5% increase from the prior year.
Almost 10% up.
For a company this size, that kind of cash generation, it just speaks volumes about their discipline.
And the market noticed?
Well, the initial reactions seemed positive, yeah. Maybe a bit modest, but definitely acknowledged this steady performance.
Okay, positive but muted. Got it. So let's get deeper then into the financial performance details.
Right, because while headline revenue was flat, organic net sales, they did see a 2% decline for the quarter.
Okay, so still a decline organically.
But, and this is where it gets interesting, that 2% decline, it's actually a big sequential improvement from Q1.
Context is key. What was Q1?
Q1 saw a 4.7% decline. So going from down 4.7% to down 2%, that's not just a number.
No, that suggests maybe a slowing of the decline, an inflection point.
That's what it looks like, a critical signal for anyone watching this space.
Definitely. So how did that break down regionally? Was it consistent?
It was mixed, actually, but with some real bright spots. North America, organic net sales were down 3.2%. Growth in Canada helped a bit, but lower sales in the U.S. pulled it down.
Still challenging in the core U.S. market then?
Seems so. International developed markets also declined, down 2.2%. That was mainly pressure in the UK, specifically in ambient meals.
Right, specific category pressure, but the bright spot.
Emerging markets absolutely stood out.
How much?
Accelerated to 7.6% organic net sales growth.
Wow, almost 8%.
Yeah, driven by double-digit expansion in Latin America and the Middle East and Africa.
So that's really firing on all cylinders. It's not just tapping new markets, is it? It sounds strategic.
Exactly. It feels like a masterclass in localization, product innovation, distribution. It's fundamentally reshaping their global footprint.
Like they finally found a repeatable growth engine outside the mature markets.
That seems to be the story. That emerging markets growth is clearly a beacon for the top line.
Okay, but what about profitability? How did all this translate to the bottom line?
Well, total company adjusted operating income declined 7.5%.
Okay, so still down overall on operating income.
Yeah. And in North America, it fell 12.5%, mostly due to commodity inflation, volume declines. Though they said productivity gains helped offset some of that.
A constant battle against headwinds in the home market, it sounds like.
It does, but look at the flip side, internationally.
Right, the other regions.
International developed markets saw an 8.2% increase in adjusted operating income.
Okay, solid growth there.
And emerging markets surged by an incredible 52.3%.
52%.
52.3%. They hit their highest adjusted operating income margin ever in emerging markets.
Wow. That's not just growth, that's a rocket ship, like you said. It really underscores their ability to drive profitable growth in specific areas, even with pressure elsewhere.
A tale of regional contrasts, really. Now, back to gross margin for a sec. Despite that year-over-year expansion we mentioned, sequentially, the Q2 adjusted gross profit margin actually declined 140 basis points.
Oh, okay. So year-over-year good, quarter-over-quarter less so. Why?
Increased commodity cost inflation hitting them harder in Q2. It offset efficiencies. But they said this was actually better than they had anticipated.
How so?
Seems some incremental inflation and trade investments they expected in Q2 are now likely to hit in Q3 instead. So maybe just timing?
Managing the timing carefully. Okay. But the cash flow, that remains strong.
Oh, yeah. Cash flow generation is absolutely a core strength. Really impressive discipline. Year-to-date free cash flow, $1.5 billion.
Billion and a half. How does that compare?
Almost 30% higher than last year at this point.
30%.
And their free cash flow conversion, 96%.
96%? That's huge.
Yeah, up over 30 percentage points year over year, mostly driven by improvements in working capital. It shows they're not just profitable on paper, they're generating actual cash.
That's crucial. Okay, but we need to talk about the elephant in the room.
Yeah.
That huge impairment charge.
Right. Approximately $9.3 billion. It's non-cash, but still, it's massive.
It absolutely is.
Yeah.
And it reflects a big hit to their market cap. What does it tell us, you think, about how the market views their long-term assets, even with improving operations?
Is it a sign of deeper trouble or more like a necessary write-down?
Well, that's the key question, isn't it? While it is non-cash, it's a direct reflection of those persistent valuation pressures. It signals that maybe certain intangible assets, like some older brand values, aren't generating the returns the market expects today.
So a market-driven adjustment.
I think so. More of a cleanup, bringing book value more in line with reality. Doesn't necessarily mean deeper operational trouble. Maybe it just clears the deck because it's a more realistic baseline moving forward.
That makes sense. Okay, let's shift to management insights. What are the strategic levers they're pulling?
Well, the leadership really emphasized disciplined pricing and those productivity gains as key offsets to the volume declines.
And the CEO specifically mentions seeing signs of stabilization in U.S. retail volumes.
Which is critical. That's something investors have been watching like hawks. It suggests maybe their pricing strategies are starting to find that equilibrium.
And they're backing it up with investment, right?
Oh, yeah. They're putting their money where their mouth is, strategically investing $400 million over the next 2 years.
In what specifically?
Productivity and digital transformation. They're targeting $2.5 billion in efficiencies by 2027.
$2.5 billion, that's huge.
And it's not just cost cutting. They talked about using AI for demand forecasting, optimizing factory processes. It's about becoming leaner and smarter. A foundational shift.
That level of investment definitely signals a long-term commitment. What about private label? That's hitting everyone.
Right. They're planning to combat that through premium tier innovation, giving consumers a reason not to trade down.
Any examples?
They teased some upcoming launches in sauces and refrigerated meals, trying to differentiate and defend share that way.
So less about competing purely on price, more on value and innovation?
Exactly. But they're also increasing investment in price itself.
How does that work? Isn't that contradictory?
Not exactly. It's about reestablishing optimal price gaps, adjusting their prices relative to competitors, especially private labels, to find that sweet spot.
Ah, okay. Making their brands more appealing without just slashing prices across the board.
Right. Using it strategically to drive trial for renovated products like Lunchables, Kraft Mac Cheese. And they're backing that up with significantly increased marketing spend.
How much more marketing?
Marketing as a percentage of sales is expected to be at least 4.8%. Media spend specifically up at least 20%. Heavily weighted to North America in the second half of the year. It's a big push.
Okay, digging deeper into North America retail. They talked about this brand growth system.
The data-driven methodologies.
It's gaining momentum, apparently. On track to cover 40% of sales by year-end. That's a big jump from 2024.
It's a 30 percentage point increase. And yeah, this isn't just buzzwords. It's potentially transformative.
How so? What does it actually do?
Think of it as moving from like shotgun marketing to laser-focused targeting. It uses advanced analytics, AI, to understand consumer behavior at a really granular level.
So they can optimize product placement, promotions, messaging.
Exactly. Everything. Making sure that big marketing spend is way more effective, focusing resources where they'll actually move the needle on sales, building growth systematically, not just hoping for it.
Sounds smarter. Are we seeing results from it yet?
Well, they highlighted tangible improvements in specific focus brands. Capri-Sun. Q2 dollar sales up over 6%.
Capri-Sun. Okay.
That's a 10 percentage point improvement versus Q1. Lunchables, 9 points better than Q1, plus they launched a new peanut butter and jelly version.
PB&J Lunchables. Interesting.
Kraft Mayo improved by 7 points. Even Kraft Mac Cheese saw a 1-point improvement.
Mac and cheese. What's new there?
New flavors for younger consumers, revamped packaging, highlighting no artificial ingredients since 2016, which is interesting they're calling that out now, and new value offerings.
Huh. Who knew you could innovate so much with cheesy pasta?
Well, it's about subtle evolution for those iconic brands. They also talked about growth in taste elevation.
Meaning?
Premium condiments, like A.1, sauce up 5%, Worcestershire sauce up 17%.
Okay.
And better-for-you options are doing well, too. Heinz Simply Ketchup up 17%, Primal Kitchen up 24%.
Primal Kitchen's been a good acquisition for them.
Seems like it. Plus, a big commitment, removing artificial colors from their entire U.S. portfolio by the end of 2027.
That's significant. A clear nod to consumer health trends. Okay. What about global away-from-home food service and such?
That segment keeps growing, 17th consecutive quarter of growth internationally.
Yeah, that's remarkable consistency.
Yeah, they're holding U.S. market share in what they admit is a challenging environment and growing in higher margin channels like partnerships with Live Nation, getting outside the home.
Innovation there, too, beyond just ketchup.
Yep. They mentioned a Heinz X honey mustard collaboration. Sounds fun.
Trying new flavors.
And this Heinz verified program for restaurants, showing good results. Participating Uber Eats places saw a 14% lift in orders.
So the Heinz brand itself drives orders, even on delivery platforms.
Seems that way.
Yeah.
Strong brand power.
And then emerging markets momentum. We touched on it, but it's worth circling back.
Absolutely. Continued strong growth. Top line accelerated nearly 8%.
And the Heinz brand specifically
Grew an impressive 18% in emerging markets in the quarter. It's now over $1 billion in sales just in those markets. Serves as a real global anchor.
$1 billion just from Heinz in emerging markets. Wow. How are they doing it?
Broad expansion, adding about 6,000 new distribution points year over year, and smart innovation like that Taco Bell Mexican food strategy in Canada.
Oh, yeah. How's that doing?
Got over 20% market share in the category in just 4 months.
4 months. That's incredibly fast penetration. Shows real agility.
Definitely. Okay, so looking ahead then, what's the guidance?
They reiterated their full year 2025 guidance, so no major changes there.
What are the numbers?
Organic net sales expected to be down 1.5% to down 3.5% for the full year.
Okay, so still anticipating a decline overall for the year.
Yes, but within that, they expect double-digit growth in emerging markets, relatively flat performance in global away from home, and continued improvement in those challenged U.S. retail categories. So steady progression, not a sudden V-shaped recovery.
Right, managing expectations. What about operating income?
Constant currency adjusted operating income, they project that to decline 5% to 10%.
Why the decline there?
Factoring in inflation, tariffs, and also a 150 basis point headwind from lapping lower variable compensation back in 2024.
The comparison. Makes sense. Gross margin.
Adjusted gross profit margin expected towards the lower end of down 25 to 75 basis points year over year.
Okay. And EPS?
Adjusted EPS guided between $2.51 and $2.67. That includes a pretty hefty 23-cent headwind from a higher tax rate, around 26%.
Got it. Free cash flow for the year.
Expected to be flat year over year, but conversion's still strong, at least 95%. That consistent cash flow remains key.
Okay. And any specifics for Q3?
Yeah, they gave some color there. Organic net sales anticipated down 1% to 2% year over year in Q3. That accounts for the Easter timing benefit they got in Q2.
Okay. Margins in Q3.
Adjusted gross profit margin expected to be similar to Q2's sequential decline, so down about 140 basis points again. That's due to that timing of inflation and promotions hitting.
Right, this shift from Q2.
And importantly, expect a big increase in SG&A investments in Q3.
The spending ramp up where?
Marketing, R&D, e-commerce, emerging markets sales force. Really hitting those investment levers hard.
What means?
Leads to an expected mid to high decline in adjusted operating income for Q3 specifically. So they're front-loading those investments.
Investing now for potential future gains. Okay, so let's bring it back to the listener. What does this all mean for you if you're tracking Kraft Heinz?
Well, look, KHC is navigating a really nuanced environment, right? The whole packaged food sector is seeing some margin recovery as input costs finally ease up a bit. But the big questions remain. Pricing stickiness. Private label gaining share. Those are still central concerns across CPG.
So investors are watching closely for sustained margin durability, yes, but also signs of real widespread volume recovery. It's a tricky balance.
Absolutely. And there are a few key signals you should probably monitor.
Like?
The upcoming September Investor Day. That'll be crucial. Any updates on capital allocation? What about that Maxwell House divestiture speculation?
Right, that keeps bubbling up. Plus, they just sold their infant food business in Italy.
Exactly. It suggests maybe a more active approach to portfolio management, not just sitting on brands.
Definitely something to watch. What else?
Obviously, the Q3 earnings report, late October, that'll be the next big test. Does that stabilization in U.S. retail volumes actually continue, or was Q2 a blip?
That could really shift sentiment.
For sure. The whole narrative around Kraft Heinz, it feels like it's clearly evolving, moving away from just post-3G retrenchment.
Right, the cost-cutting era.
Towards something more like measured reinvestment and trying to spark strategic growth.
They've shown they can manage margins, pull those levers. But future upside seems increasingly tied to rekindling sustainable growth.
Whether that's organic, through innovation and brand investment, or through bigger portfolio moves like divestitures or acquisitions.
And don't forget the shareholder returns piece. They're maintaining that competitive dividend, yielding over 5.5% right now.
Which provides some support.
And active share buybacks. Still got about $1.5 billion left on their $3 billion authorization. So disciplined capital allocation is still part of the story.
Okay, so now for something a little different, a segment we call Not Financial Advice.
Absolutely clear. This is not financial advice. It's just for education, maybe sparking an idea. Think of it as an outrageous but plausible pitch.
Okay, so despite those volume pressures we talked about, despite the big non-cash impairment, KHC's Q2 results really did underscore some strengths.
Robust margin management, exceptional cash flow, and that clear strategic pivot towards reinvesting in brands and digital.
Right. But the market's reaction was, as we said, kind of positive but muted.
Potentially underestimating the long-term effects of these shifts and the portfolio rebalancing potential.
Maybe. So here's the outrageous but plausible proposition. Consider a long position in KHC, maybe via a relatively long-dated call option.
Something like a January 2026 or even January 2027 expiry.
Yeah, with a strike price slightly out of the money, say $40 or $42. It's a bet on the long game.
What's the aim of that strategy?
It aims to capitalize on that financial discipline KHC has, plus the optionality baked into the story now. We see maybe two primary catalysts that could drive a real re-rating of the stock beyond what the market seems to be pricing in.
Catalyst number one.
Aggressive portfolio reshaping. Think about it. They didn't comment on Maxwell House, but they did just sell the Italian infant food business.
Suggests they might be more willing to make moves now.
Exactly. Imagine a significant divestiture of a lower growth asset, maybe using the proceeds for targeted acquisitions in higher growth areas like emerging markets or premium segments.
That could fundamentally alter the market's perception of their growth profile, couldn't it? Re-rate the multiple entirely.
That's the idea. That's Catalyst 1. Catalyst 2.
This one ties back to those investments they're making.
Right. Innovation and productivity inflection point. That $400 million investment in digital, the brand growth system, it's not just about cost cutting.
It's designed to drive future top-line growth. Better innovation, more effective marketing.
So the second catalyst is, what if these investments translate into an accelerated volume recovery in North America sooner and stronger than expected? Say, late 2025 into 2026.
Combined with continued margin expansion from AI and efficiencies.
Then KHC could deliver an earnings surprise that really propels the stock higher.
So the overall thesis for this speculative trade.
The thesis is, this kind of trade offers leverage against that short-term volume noise while positioning you for a significant re-rating if the market starts recognizing the payoff from these long-term investments and potential portfolio moves.
It's basically a bet on KHC successfully transitioning from that old retrenchment story
to a more compelling growth and value creation narrative, which ultimately should lead to a higher valuation multiple.
Makes sense as a potential scenario.
Okay.
Let's sum things up.
Right. Kraft Heinz's Q2 2025 results, they highlight a company with strong financial discipline, making strategic investments, showing real, tangible progress in key areas like emerging markets and trying to revitalize those big North American brands.
They're clearly leveraging productivity gains to fuel future growth and navigate this really complex consumer landscape. It feels like they're taking decisive steps to shift their story.
So the big question remains, doesn't it? As consumers keep prioritizing value, as private label keeps nipping at their heels, how effectively can Kraft Heinz's big investments in brands and digital truly reignite sustainable top-line growth across that iconic portfolio?
That's the multi-billion-dollar question for the quarters ahead. And as always, the information we shared here is for your education and understanding.
Definitely not financial advice. We'd love to hear your thoughts on Kraft Heinz's outlook after this deep dive. Thanks for tuning in.